Have you ever come across a business problem that just seems to defy all logic? Well, today we're diving into one of those. We're going to explore the super counterintuitive world of international business, where charging a higher price for your product can actually make your company poorer. Yeah, you heard that right. It sounds bizarre, but it's a very real trap that we're going to break down right now.
So, let me just start with the central puzzle. Picture this. A company deliberately makes a choice that causes one of its own departments to show zero profit on its books. I mean, why on earth would they do that? Isn't the whole point of business to make a profit? Well, what if I told you that making one part of your company look completely unprofitable is actually the secret to making the entire organization wealthier? It sounds completely backward, I know, but that's exactly the mystery we are going to solve together.
To make this real, let's talk about a company we'll call QuickLink. They operate in different countries, and they have this one internal pricing decision to make. But it's not some small detail. The choice they make could literally swing their profits by 60 lakh rupees. The stakes are definitely high.
Okay, so to really get what's going on with QuickLink's dilemma, we first need to understand the playing field. We need to meet the key players inside the company and get a handle on the financial rules they're forced to operate under.
The big concept at the heart of all this is something called transfer pricing. Now, this isn't the price you or I would pay for a product. This is the price that one part of a company, say the factory, charges another part of the same company, like the sales office in another country. You can think of it like moving money from the company's left pocket to its right pocket. But as you're about to see, how you move that money from one pocket to the other can have massive consequences.
Now, this slide is where the plot really thickens. We have two key players. First, QuickLink India. They're the manufacturers, and they're in a country with a 35% tax rate. Then you've got QuickLink France. They're the sellers, and they're in a country with a higher tax rate, 40%. And here's the kicker. France has to pay a 15% import duty on the value of whatever goods India sends them. These three little numbers, the 35% tax, the 40% tax, and that 15% duty, are the absolute keys to cracking this whole puzzle.
All right, so QuickLink is staring at two very different strategies for setting this internal transfer price. Let's put them side by side, do a little head-to-head comparison, and see what happens to the company's money in each case.
So here are the two options on the table. Method A is pretty straightforward. The Indian division just charges the French division exactly what it costs to make the product. 12,000 rupees per unit. No profit, no loss. Method B, on the other hand, seems way smarter at first glance. India charges a higher price, closer to what it would be on the open market, 15,000 rupees. Now, your gut instinct is probably screaming that Method B is the no-brainer, right? More revenue for India must be a good thing. Or is it? Let's run the numbers and find out.
Let's start by looking at the books for the Indian division. Under Method A, their revenue is exactly the same as their costs, so their operating income is a big, fat zero. Nothing. This is the exact situation from our puzzle at the beginning. But look at Method B. Suddenly, they're showing a very healthy operating income of 15 crore, which leaves them with a really solid profit even after paying their 35% tax. So if you're just looking at India, Method B looks like the obvious winner. But that's only half the story.
Now, let's flip over to the French division. Their final sales revenue to outside customers is the same in both scenarios. That makes sense, but just look at what happens to their costs. In Method B, not only is the price they pay India higher, but that painful 15% import duty is calculated on that higher price. It's a double whammy. Their total costs just balloon, which completely crushes their operating income. And as a result, their final after-tax profit just plummets.
Okay, time to add it all up. Let's look at Method A, the one where the Indian division showed zero profit. When you combine India's profit, which is zero, with France's after-tax profit, the total company-wide profit comes out to a very respectable 12 crore and 60 lakh rupees.
And now for Method B, the one that made the Indian division look like a superstar. When you take their big profit and add it to France's tiny profit, the grand total for the entire company is only 12 crore rupees. That's 60 lakh rupees less profit for the company as a whole.
And there you have it, the strategy that on the surface looks so much better, the one that made the Indian division look amazing, actually made QuickLink as a whole poorer. So what is going on here? What is this hidden financial trap that's at play?
Okay, this is the moment where it all clicks into place. We're about to break down the hidden chain reaction of taxes and duties that explains this completely bizarre result. This is the kind of logic that every manager in a global company absolutely needs to understand.
Let's just trace what happens for every single rupee that India decides to increase that transfer price. Step 1, India gets an extra rupee of revenue.
That rupee gets taxed at 35%. So right away, the company as a whole has a new cost of 35 paise. Step 2, France has to pay import duty on that extra rupee. That's another 15% cost, so another 15 paise gone. Step 3, now here's the clever part. Because France's costs have gone up, their taxable income goes down. This actually saves the company money on its French tax bill, a saving of 46 paise. So let's look at the final score. You've got new costs of 35 paise plus 15 paise, which is 50 paise, and you have a saving of 46 paise. The costs are higher than the savings.
So here's the bottom line. When you add up the new costs and subtract the savings, the net effect is a loss. For every single rupee that they increase that internal price, QuickLink as a whole becomes 4 paise poorer. Now, 4 paise might not sound like a lot, but when you multiply that by millions and millions of rupees in sales, it turns into a massive, multi-lakh rupee mistake.
So the math is pretty clear, right? But business isn't just about spreadsheets and numbers. It's about people. And this pricing decision creates a really tricky situation for the managers involved. Let's explore the human side of this.
This quote right here just hits the nail on the head. It perfectly captures the problem from the perspective of the manager in India. Imagine you're that manager. The best strategy for the entire company makes your own division's financial statements look like you accomplished absolutely nothing all year. I mean, who wants to go into their performance review with a big fat 0 to show for their work? And this is where you get a classic conflict of interest. The Indian manager's personal incentive is to make their division look profitable, which means they'll naturally want to argue for that higher transfer price. But that's directly against the best interest of the entire company. So what do? Well, the solution is to change how you measure success. The company needs to stop evaluating the Indian division on profit. Instead, they should look at other things, non-financial metrics like product quality, being on time with deliveries, or how well they control their costs. Those are the things that truly help the company win.
Okay, we've gone through the numbers, we've looked at the human element. Let's wrap this all up and crystallize the key lessons you should take away from this whole QuickLink case study.
You know, if there's only one thing you remember from this, let it be this. In a global business, you can't just look at one department or one country in isolation. A decision that makes one office look fantastic can be an absolute disaster for the company's overall health. The only number that truly matters at the end of the day is the final total profit for the entire organization, period.
All right, as promised, here is your quick formula flash recap. Remember, the key calculations we used were import duty, which was simply the transferred price times 15%. The division's income tax was its operating income times its local tax rate. The total company profit was just adding up the after-tax profits from both India and France. And finally, the most important one, the net impact formula, which was the increase in taxes and duties minus the tax savings. It was that last little formula that really unlocked this entire puzzle for us.
So we'll leave you with this final thought to chew on. The QuickLink case wasn't really a math problem at its core. It was a people problem. And that's the real challenge for any big company. How do you design your systems and your incentives so that what's best for an individual manager is also what's best for the entire business? You want to create a world where when an employee wins, the whole company wins too. Thanks for joining us for this deep dive.